I think there is a big divergence between what the headline indices are indicating, making a new high, and economic activity being, fairly subdued. The divergence is also, reflected in the corporate earnings as well. So while Nifty in last 5-6 years has given about 11% kind of a returns, the corporate earnings have only grown at about 3.5%. I think what is keeping the flows steady is large domestic flows. So we have retail investors pumping in more than $1 billion a month. I think that is keeping flows steady. And also some stability, I'm not sure with what Trump has done on Hong Kong, whether the first phase of trade deal would over or not. I think that's also kept the overall EM basket alive. I think what is keeping the markets buoyant is the government dishing out reforms after reforms. So what started off as a corporate tax cut was followed by a package on real estate, which is the epicenter of the current financial crisis in shadow banking. And then we saw, last night, a slew of reforms in telecom, as well as government deciding finally to, divest strategically some 5 PSUs. Just to remind you, the last big ticket private divestment the government did was in 2002, which was Hindustan Zinc. So we really haven't had a strategic divestment where the government cedes control and leads to value unlocking. So that's one space which is looking quite attractive now.
Right. Let's drill it down to stocks, right? Because there's so much happening at the micro level in India. Yes Bank, after what we've witnessed, the stock dwindling down to 2 digits, being a high 3-digit stock just a little while ago. Do you think that all this grapevine chatter about a big investor coming on board will help support the stock from these levels?
You're right, Tanvi. The issue is more trust than valuations. I think there's no point looking at price to book ratios when the book itself is under question. I mean, we saw RBI reporting a divergence of almost $500,000 of non-performing assets in last year, just about 2 days back. So, till the time a credible name comes in, it's best avoided. There are better opportunities. What we are seeing is that there are a lot of private sector banks, the top rung ones, which are continuing to gain market share and now coming out of the woods. The likes of ICICI, Axis, they will be raising capital. The asset quality issues are behind them. There are also a lot of tier 2 banks where probably there is a more perception risk than actual risk in the book. The likes of DCB, a federal bank, something like a DCB right now, on a 3 billion kind of a book, more than 75% of the loans are less than $500,000. So that makes the book pretty granular and with a strong liability franchise. So maybe one can go a notch up right now in terms of going from tier 1 banks to tier 2. But looking at value buys and speculative bets like Yes Bank or a DHFL is best avoided. There are enough opportunities where you can still see some turnaround happening.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.